Right, Ajay, firstly, thanks very much for taking time out to chat with us. Now, the final draft guidelines for new bank licenses are out. The final guidelines should be out from the Reserve Bank of India, one would imagine within the next 6 to 8 months at least. Should we expect that AV Birla Group will apply for a bank license?
Yeah, I think, like you say, it's a forward-looking step that the guidelines are out. I think these are still draft guidelines, so there are still comments invited from the public, which will be done by October. Then you'll get a final set of guidelines. I think we've said before that we're a large non-banking financial services company today, and a bank makes strategic sense to us, and it therefore is a good fit. So should the guidelines afford us that chance, and should the approval process allow us to do so, yes, we would definitely be interested in applying for a bank.
Sure, but the entry hurdles this time around are a little steeper than they were when you had the last two licenses handed out in 2002, 2003. For one, you've got a higher capital requirement of 500 crores as opposed to 300 crores last time. You've got a capital adequacy ratio which will have to run at 12% for the first 3 years, and again 25% of your branch network will have to be in centers with a population of 10,000 and less. Would you say that puts you at a disadvantage compared to current incumbents?
I don't really think so, George, and I'll give you why. Because I think if you look at the capital requirement per se, 300 crores was a number set almost 10 years ago. So if you just look at that from an inflation perspective, that's well over 500 crores today. So that's not really much of an ask relative to the 300 crore number that was there prior. I think the capital adequacy number, if you look at the average for the private sector today banks, most of them have a capital adequacy significantly more than 12% and are still generating reasonable returns on equity. So my guess is that again, that is not a steep ask. And I think the third aspect in terms of the number of branches and 25% of them being in rural India, to my mind that is in line with the whole financial inclusion pitch. And just given the way India is growing and the spread of India, I think that's much more of an opportunity than an obligation really.
Just looking at the makeup of AV Birla Financial Services, you're presently made up of about 5 companies in addition to your asset management company and your life insurance venture.
Yeah.
But ultimately, what form do you expect this venture is going to take, and what will it look like maybe in the next few years or so?
Okay, so let me just tell you what the financial services group actually comprises and where we stand today. Like you said, we have basically 7 lines of business. So we're a large non-bank financial services company. Other than a bank, we're present in almost all sectors that we want to be present in. We are a large life insurance company. We have a market share there of just under 9% in the private sector. We're a large mutual fund. We have a 9% stake in 9% market share in the mutual fund space. We're a reasonable size NBFC, but growing very rapidly. We have a private equity business, which is again about a year and a bit old, but again building its assets as we go by. We've got a general insurance broking business. We have a wealth management business, and we have a retail broking business. If I look at the aggregate of all of these entities put together, our view is that it meets the non-bank requirements of a customer, be it an individual customer or a corporate customer, in a fairly exhaustive and comprehensive manner, which is really what we're trying to do. Just in terms of numbers, if I look at our numbers as of financial year last year, so March last year, we had aggregate revenues of about 6,300 crores, an operating profit of about 460 crores PBT, and consolidated assets under management of about 90,000 crores. In Q1 of this year, our revenue is about 1,330 crores, and our profit before tax is about 177 crores. So we're fairly large in terms of our footprint, in terms of both lines of businesses, as well as our presence across the geography. We will continue to look to grow each of these business lines, and as the requirements of our customers kind of evolve, and as long as we have the regulatory permission to be able to enter lines of businesses, we would like to see how we could expand our portfolio in line with what our customers would like.
So should one expect that AV Birla Financial Services will ultimately assume the role of the FOHC, that it will be the holding company for all lines of businesses that you own, and also that the bank, should you get a license, will also become a subsidiary of that holding company?
I think the draft guidelines are fairly clear in terms of the structure that the RBI is looking for. So in the event you do get a bank, the RBI is saying there should be a non-operating holding company. The bank is a drop-down subsidiary, and all other financial services companies will be drop-down subsidiaries from this NOHC. So in that case, yes, the structure that you just described would probably be the structure we'd end up with.
Just focusing at your life insurance venture, there's a lot of value waiting to be unlocked in that venture. Now, once the IRDA does come out with its final set of guidelines for IPOs of life insurance companies. Should we expect that you will take the life insurance venture public?
We haven't really thought about that, George. So I would say that this is not something that is imminent at our end in terms of a listing of our life insurance company.
Right now, Ajay, you're also betting big on the financial services story in India. You've pretty much got your fingers in every pie of the financial services space. What's the opportunity you see in this business? Because it is at some level being argued that financial services is beginning to get crowded out. You are having a number of players that the going is going to get tough for a lot of them.
See, I think financial services plays very much to economic growth, George. Typically, anywhere in the world you look, financial services grows at some multiple of GDP growth. Given the strong growth in India in terms of GDP, our view is that you're going to see very attractive growth in financial services per se. In addition to just the GDP growth and therefore the growth in income, Indians save a lot of money. So again, that's a good raw material for people like us in the financial services business. But I think to make all of that happen and therefore to convert some of these savings to really something that works for providers like us, I think there has to be a process that works on financial literacy at one end, which allows investors to take more informed decisions, and that will involve a mix of communication, a mix of products that are structured and engineered to deliver that, and a distribution mechanism that can carry that message to the individual investor. So I think if we get that package going, then we can really convert all of this potential into something significant.
So you've also got this huge offshore opportunity. You've got so many Indians working overseas. Annual remittances are to the order of close to $50 billion. What is AV Birla Financial Services doing to tap that opportunity?
We see that as a big opportunity, and it goes to the question of what will we see as we go forward, how attractive does India become as a destination for foreign investors, and we think it will be attractive. And therefore from our perspective, we've gone about and set up a branch from our asset management company. We've set up a branch in both Dubai and in Singapore, and those will both act as focal points to attract money from Asia on one side through Singapore, and through the Middle East and Africa through our Dubai office, because we see that as an opportunity to be able to garner assets from outside of India, which are specifically India focused.
But general insurance is another business where you do not have a presence in. Of course, the sector is pretty much everyone's losing money, and at the same time, you've got a number of people looking to exit that space. Would you be looking at entering general insurance?
It's a space that we have looked at in the past. I must admit that it is a large sector, so we have looked at it, and we couldn't really find a way that we thought we could effectively compete in the sector, which is why we chose to stay out. Having said that, there are segments of that sector that are interesting. So if you look at health insurance, for instance, we believe health insurance is a very large and growing area in the country. So there could be an opportunity for us to see how we can participate in the health space. We're already doing that in a large way through our life business. But we just couldn't find the way that we could really compete in general insurance, which is why we chose to stay out, and which is why we continue to be there.
So on the health insurance front, should we expect that you will look to identify a partner possibly and set up a separate venture to enter that space?
Again, that's too early to say. We don't have immediate plans in that area. I was just saying general insurance as a whole it covers a number of areas. In that, if you look at areas that look attractive from a growth perspective, clearly health insurance is one of them.
Just to the extent that health insurance is attractive, would you consider entering it?
We're already in health insurance through our life insurance business, and I think we'll continue to grow that as well.
Now, one of the big factors that have hurt life insurance companies has of course been the ULIP norms having changed since September of last year. What's the impact that it's had on Birla Sun Life?
I think since the change in regulations, I think the whole industry has been recalibrating its business model, because it's clearly impacted distribution and product for the entire industry. I think since October last year, broadly the industry new business sales have dropped by about 40%. I'm talking about last financial year, so October to March. If you look at the Q1 of this year, again broadly the numbers are in that range. We've done relatively better than the average of the industry, which has meant that we've gained market share. So while the industry has dropped 40% in Q1, we've actually dropped by less. We have had a decline, but we've dropped by less than that. and that's meant our market share has gone up from about 8.1% in Q1 of last year to about 8.8% in Q1 of this year. So I would say, we're seeing the market still in decline mode, but we're doing relatively better.
Sure. Now, the general consensus is that, the fundamentals apart, we do have the equity markets looking extremely weak due to, various fundamental issues both at the global level and at the domestic level. But one of the factors being cited for the weakness in the equity markets is the fact that flows from the insurance sector have dropped by almost half since last year. Would you agree with that view, that the very fact that flows have dropped by half has been one of the big reasons why we are seeing weakness in equities?
I think that's a good question, and let me answer that in a few ways. I think, yes, flows to the sector and therefore flows from the sector to the market have fallen. In FY9, FY10, broadly there was about 55 to 60,000 crores going in from the industry into the markets, invested into the markets. In fact, in FY9, the domestic insurance industry actually invested more in the market than FIs took out, which is why the market remained reasonably stable. That number has fallen significantly. So if I look at FY11, that number is now down to about 35 to 36,000 crores. So it has fallen. The insurance industry investment in the market has reduced. I think the second point is, as long as the industry is falling, obviously that number is going to continue to be under some pressure. But not only are new business numbers falling, the other thing that we're seeing in the market is the whole change from a ULIP portfolio to now a more balanced portfolio between ULIPs and traditional products. And traditional products by definition are more fixed income in nature than equity. So even if growth rates bottom out and start picking up, the product mix having changed, I think you will see a lower amount of equity flows from the insurance industry into the market. The third point that I'd like to make, I think, is that if you look at the structure of our equity markets, I think if you look at most international markets, you have three broad pillars of an equity market. You have the pension sector, which is typically a very large and solid pillar. You have a large life insurance sector, typically in most markets, and you have a mutual fund sector. In our markets, I think the pension fund industry really isn't very largely invested in equities. Life insurance is under some pressure and flows have come down. And mutual fund flows have been significantly lowered since the no-load regime. So I think structurally now we have not the large domestic base, domestic institutional base. You would need to build a strong capital market. And therefore I think we are much more now dependent on foreign flows really to drive the direction of our equity market.
So in some sense, would you say that it's actually regulatory hurdles that have been created that have actually restricted the flow of money to the equity capital markets, and that actually the money is available, but it's these regulatory restrictions that is sort of in some sense impairing the equity markets?
Yes, I think there is money clearly in the system. I think India is still growing reasonably attractively, and Indians still save a reasonable amount. But I think given the rate, the rise in interest rates, given where fixed deposit rates are today, traditionally we would have expected money to move from deposits to other forms of investment. We would have expected a move from physical assets to more financial assets. I think we are somewhat seeing the reverse of that. We are seeing a move back into physical assets. So you're seeing much more increase in gold, real estate, and within the financial sector we are seeing again a resurgence of deposits. So it is in a sense going back a little bit in time.
Right now, given all of this, what's the outlook for domestic equities for the remainder of 2011?
I think from a valuation perspective, George, I think equities look attractive at this level. I think earnings, if you look at a multiple on earnings, we are still very attractively valued. So from that perspective, I see not that much more downside to markets from where we are. But just given the structure of the market that I described to you earlier, and given we are so dependent on foreign flows, we are no doubt going to be impacted by what's happening in the rest of the world. And my view is that you are going to see more volatility in the rest of the world, and therefore we are going to be subject to some amount of that. So I would say, markets look reasonably attractive at these levels. I don't see much downside at this point in time at least, but I think you are going to have some volatility around this.
Sure, but while you do say that the markets look attractive at current levels and that will remain volatility in the markets for some time, within all of that, which sectors would you say look most attractive to any investor?
I think you would look at sectors that have been really hit the most, because I think that's where you get typically you get the cheapest valuations, and sectors that I think will drive the growth of India going forward, because India is a growth story, and you are going to see sectors where growth is really the factor that are going to drive. So I would say look at the infrastructure sector, for instance. That's been hammered a fair bit. You look at the banking sector, that's been hit a fair bit. So those are sectors that I think, as some visibility emerges in terms of the growth in these sectors, you could start seeing some interest there.
Sure, you did mention the banking sector and also infrastructure. But again, to the extent that everyone believes that the rate cycle is pretty much approaching its peak, and the fact that the broader rate-sensitive pack has been hammered out of shape over the course of the last few months, would you say that now is possibly the best time to be buying into rate-sensitive stocks?
Yeah, I think that question is really going as to whether we believe the rate cycle has ended or not. Our in-house view is that our base case is probably another 25 basis point hike, but there's a small chance that there is not a hike at the next policy announcement. So yeah, we believe that we are if not at the end, close to the end of the rate hike cycle. I think the market is already pricing that in. If you look at the way the fixed income market is pricing rates in, the fixed income market is indicating that actually we are close to the end of the rate hike cycle. I think that will be a big trigger for equity markets, obviously, and clearly rate sensitives will benefit from something like that happening.
Now, looking at the Indian economy broadly, you have on the one hand the government talking, or rather remaining optimistic, that you are going to see growth levels of greater than 8%. The chairman of the Prime Minister's Economic Advisory Council maintains an 8.2% number. On the other hand, you've got brokerages downgrading India growth rates to 7%, 7.5%, even 7.2% in certain cases. Where do you believe we should expect that growth will, at a reasonable level, come in at?
So I think there is some volatility and buoyancy around the numbers, and that's why you get the range that you're talking about. Our in-house estimate is broadly between 7.5, 7.75. But having said that, I think there are a couple of factors that could surprise on the upside. So if those things kind of fall in place, so if you get agriculture to chug in at a better rate, if services comes in at a slightly better rate than we expect, or if investment demand kick-starts in the second half of the year, we could end up with an 8% GDP growth.
At the current juncture, while the domestic consumption story for India continues to look strong, what do you believe could likely be the party pooper for India? Do you believe it's going to be the policy paralysis that we continue to see at the center? Do you believe it's going to be oil? Do you believe it's going to be a blowout in global markets?
So I think the two big themes that are playing across the world are typically debt and public debt in that sense, and clearly from India's perspective, oil, and I think that the two in some sense is linked, just given the way India works. I think from a debt perspective, actually India looks very good relative to the rest of the world. Yeah, we do have a bit of a strained fiscal deficit relative to our expectations, but we still have an economy that's growing nominal 17%. So when you're growing nominal 17%, you have the ability to live with some amount of fiscal deficit. Whereas in the Western world, they're growing at 3-4% nominal, and they have fiscal deficits of 6 to 7% of GDP. So I think the fiscal deficit, therefore, in India is I think slightly over-exaggerated in terms of an issue. I don't think it's as big a problem as it is elsewhere in the world. Oil is the second area, and clearly there is worry that a spike in oil prices has a big impact on India in terms of both inflation and GDP. And yes, it does. But I think over the period of the last 5-10 years, I think two things that we've noticed. One is just the elasticity to price. So if petrol prices rise, we clearly see the demand for petrol falling, and therefore there is some self-correcting mechanism that works. And second is just the efficiency of the usage of petrol consumption. So, I think since 2007, petrol consumption has probably risen 17%, whereas our nominal GDP has grown significantly more than that. So therefore, we are not consuming in line with our GDP growth, and you should therefore assume some efficiency in use. So even oil therefore becomes less of an issue. So my sense is that the India is actually not in that bad shape, and probably is in a good spot to capitalize on what's happening around generally in the global sense.
But how about the issue of policy paralysis? Because most foreign investors you speak to, even corporate heads that you speak to, say that that to us is the bigger issue than other issues like commodity prices going up or interest rates continuing to climb.
So it would definitely help if the reform process was reactivated and people could see that working. I think that would drive sentiment. It would clearly drive more flows from other parts of the world into India. But I think there are many other things already working in the India story.
Now, at a global level, what do you believe is going to be the bigger concern for investors? Do you believe it's going to be the likelihood of the US slipping back into recession, or do you believe it's going to be the US sovereign debt problems?
I think you mean the euro sovereign debt problems. I think both are significant issues, George. Our own view is I don't think the US is likely to slip into recession. I think they have issues, but I think there are a number of things that are being done to address all of them. So while you are seeing significant slowdown, a double dip at least at this point doesn't seem likely. I think the euro debt crisis is probably more significant and from our point of view a little bit more concerning. Because the size of the banks, the size of the capitalization that would be required to recapitalize these banks if sovereign debt is to be provided for, and the other implications of all of that from a political perspective, from the eurozone angle, I think those are much more significant. And I think that, to my mind, is something really to watch out for more than what happens in the US. And of course, there are spill-off effects of that in terms of the rest of the world if that happens.
Sure. Now, if matters in the OECD region were to worsen, as everyone believes it will, do you believe in some sense that's actually going to work as a positive for emerging markets like India, to the extent that it actually redirects foreign fund flows to this part of the world?
Absolutely, because I think you have a world today where you have low interest rates in the rest of the world and you have ample liquidity, and that liquidity is going to seek returns, and I think that return will be sought in markets such as emerging markets and asset classes that we've already seen. So yes, I do believe that we should see the benefit of that.
Now, the other issue is we continue to see global growth slowing in the OECD region. The impact of that slowing growth having its impact on emerging markets, and all this time you've had central banks in emerging markets saying that inflation is going to be our focus, growth can take a backseat, pretty much on the lines of what we're seeing happen in India. Yeah. But over the last week or so, we're seeing many of those central banks abandon that approach, beginning to say that growth is important. Inflation, even if it is for a brief period, can take a backseat. We need to focus on growth. Brazil's been the first to move. They've actually cut interest rates. Korea and some other countries in some other emerging market central banks have actually stopped raising rates. Do you believe there is a case for the RBI to move in that direction?
I think that inflation is an issue in a country like India. It's high, and I think it's structurally high, and clearly impacts the poor more than anybody else. So I think therefore, from our perspective, the RBI is right in looking at setting inflation right before and building a base for future growth. Having said that, I think there are many other factors that have to work as well, and beyond a point, you have to look at supply side, you need to look at the fiscal as much as you look at the monetary side to address these issues. So our own belief is that we will start seeing the rate cycle easing out. We will start seeing inflation kind of topping out, and therefore after that is when you will start seeing the pause in interest rate hikes first, before you can start seeing any reduction.
All right, Ajay, thanks very much.
Thanks, George.